Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas, home of the Mean Green Eagles. Love it there. I teach intermediate accounting 1 and 2, and today's lecture is about lease accounting on the work lease accounting problems. That's going to be great fun. And this is primarily for my Accounting 3120 students at UNT, but it is published to YouTube. And therefore, I want to give a lot of credit to the McGraw-Hill textbook, Intermediate Accounting. That's the Spiceland, Nelson, and Thomas textbook. It's a great textbook. So with that, share my screen and get started here. And so if you've been watching my lectures, the first thing I ask everyone to do is, I suggest, is that you pause the video and you try to work these problems on your own, restart it, and then see how it goes. When I work it, see you can compare your answer to mine. Maybe you'll find one of my mistakes. Please let me know if you do, because I want to correct that. And when I'm up in front of the classroom, I get a lot of corrections. I make a lot of mistakes. So with that here, I'm going to pause for a second here, let you pause the video and work this problem. Okay, here we go. So what are we trying to do? One thing, I'm just going to make sure that this video is recording. Yes, it's recording. Let me share my screen again. I don't want to screw that up and have to retape this. I've been doing this all the time. Okay, so this is exercise 15.1. And so there's 4 different situations here. And we want to know if these are going to meet one of the 6 criteria. You might remember those as, is there a bargain purchase option? It's one of those, does the ownership pass at the end of the lease? Is this lease of equipment, is equipment only can be used by the lessor, nobody else? And then the 2 bigger ones that usually we all have to do some math around is, number 1, is the lease term comprised a major part of the economic life of that asset? And that usually is, we refer to it being about 75%. Second criteria is the net present value of all the future lease payments, is that substantially all of the fair value, represent the value that's substantially all of the fair value of the equipment, and that's usually at 90%. So let's run through these here. I printed this out, make it a little bit easier. And I need a good pencil. All right, I don't know what happened to my other pencil, but that's all right. So let's look at 1. The lease term is 4 out of 6, 60%. So that is a no, that's not 75% there. Then the asset's fair value is $44,000. So we're going to have to calculate the present value of those lease payments. We'll do that in a minute. In the purchase option, no, so that's a no, and this is a no. Timing the payments beginning of the year. So let's go do our present value. So the lease payments are at the beginning of the year, so that's going to be a present value of an annuity due. And so the lease payments are $10,000, and they're 4 years, annual lease payments. So I need the present value of annuity due. Got my calculator out here. Let me clear everything out. And so I've got $10,000 payments in. Oh, one thing I didn't do, I know right off the bat, I got to put this in the begin mode. You'll see a little begin there on my calculator, if you can see that. And I got to make sure that if you're in exam and you put it in begin mode, you got to put a note to self. Take it off the begin mode for the next problem if you need to. And we'll see that we will have to. So I got it in begin mode now. That's good. 10,000. And those are the payments. And I've got 4 equals n. And I have to use the implicit rate if I know it. It doesn't matter here because they're both 5%. 5% interest rate. And I'm going to calculate the present value and that is 37232. And I'm going to divide that by 44,000. 84.6%. No. So this one is a no. It's going to be an operating lease. I only have to meet one of those criteria and it's over. I'm in the finance lease or the sales type lease. All right, let's look at number 2. 80%. Yes. Purchase option. Yes. So I'm already in. So this one is definitely a yes. I'll go calculate that, present value. Well, I already know the answer is 34,651, and that's at 81%. So that is not substantially all. Substantial all would be at 90%. But we're already at major part, and we have a purchase option that is a yes. And so this is definitely a yes, and where this one is a no. Number 3, 66%. That's a no. That's a no. That's good. Let's go calculate. And this is a present value of an annuity due, 10,000. Is this going to be exactly the same? Exactly the same as this one, so I don't need to recalculate. 37,232. This is still N equals 4, $10,000 payments. I equals 5%, same as number 1. So now it's 37,232, substantially all of 41,000. 37,232. 91%, 90.8%. So that's a yes. I've met one of the criteria. I only meet one in this case, but it's still a yes. All right, 66% here. That's a no. 39,000. I don't know that. That's a no. And these are end of the year, so I'll put my calculator back in the in mode. And let's go calculate that. Well, you know what? I already know. It's the same as this one. Nothing has changed. We have to use the lessor's implicit rate if we know it, so we know it. And so it's going to be that same 34,651. We'll divide to that 34,651 divided by 39,000. 89%. You know what? 90% is the rule, generally, but it's close enough. So that's close enough to call substantially all. In the old rules, that would have been a no, because even at 89.99% would have been a no. So there you go. This is how, again, you only have to, meet one of these criteria. All right. Exercise 15-4. We're going to do some journal entries now. All right. So take a look at this. We're going to make semi-annual, so 2 payments a year of $562,907 over a 3-year lease term, payable each June 30th and December 30th. And the first payment is June 30th, 2018. So this is going to be a present value of an annuity due, right? And incremental, Georgia Atlantic's incremental borrowing rate is 10%, the same rate that IC used. So we're looking at 10%. So I'm going to do both the lessee, the lessor and the lessee's account. I think they're only asking for the lessee's accounting, right? Because what IC reported on its income statement. So yeah, you have to kind of, when you get to these names, Georgia Atlantic lease warehouse equipment from IC Leasing. So IC Leasing is the lessor. So they're asking for the lessor in here. Guess what? I'll probably go ahead and do the lessee anyway, just to it'd be helpful for you guys. So turn this back around here so I can see all this. Let me get rid of my floating meeting controls here. $15,400. All right. So step one, we got to go calculate the net present value of those leases. And so if the present value of annuity due payment equals 5. Let's see if I can turn this around a little bit. 562, 907. N equals, this is a 3-year lease times 2, because there's semi-annual payments, I believe. Semi-annual payments, 2 equals 6. And I equals, you got the 10%, but I got to divide that by 2, right? Because it's 2 compounding periods. So each compounding period is gets the 5%. All right, get the trusty calculator out. I'm gonna clear everything. I'm gonna make sure I'm in the begin mode. You know, don't make that mistake. Payments 562,907. 6 equal N. 5% equal interest. Present value 2,999,999. Well, I'm going to call that $3 million. So that's the present value of the lease payments for both the lessor and the lessee in this case. Thank God they made it easy for us. So let's see, you know, what amounts related to lease would I see report on its balance sheet at December 31st, 2018. So so we only have to do one period. That's kind of good news here. So June 30th. What's the first entry? And we're going to do IC first. That's what they asked for, and that's the lessor. And debit. Lease receivable. By the way, one thing I just skipped over really quickly, I don't want to do it. IC purchased the warehouse from Builders Inc. at a cost of $3 million. So the net present value of the lease payments are $3 million. The cost for the lessor was $3 million. So no selling profit. So that makes this first entry easy for us. We don't have to do the revenues and the cost of goods sold. We just do that lease receivable, and we credit. We get the equipment. This is equipment, right? Equipment off the books. If the equipment cost less than $3 million, we would credit the equipment for whatever that was, and we would also credit revenues and debit cost of goods sold. So we would create an income statement. Now, the other thing that happens on June 30th is a payment. So debit cash, and the payments are 562,907, and credit the lease receivable. So it's kind of interesting in this accounting that we put the lease receivable on the books at that present value, and we go ahead day one and we take the first payment off of that. And so the balance in that lease receivable account now is $3 million minus the 562. Let's just say, you know what, the new, if we're going to need this new lease receivable balance equals 3 million minus 562,907. That's good. $2,437,093. And so again, we started with a debit to that, And then we did a credit there. So we got a debit sitting out there of 2,437,093. Okay, now we've got to go to the first lease payment. You'll always get there on an exam at least, 1231. And so we have another debit of cash, 562,907. Now, this is like the installment loan. If you watched my when I worked the installment loan problem, this 562, part of it is related to interest expense, and part of it is going to reduce that lease receivable down. And so, what is and I said interest expense, interest revenue, because this is the lessor. The lessee will have receivable. So what is their revenue? It's the 2437. So credit interest revenue. And it's going to be 2437,093. Still have that in my calculator, times 5%. Because it's for 6 months. The rate is 10%, but we divide by 2 because this is only 6 months. So 5% and 121,855. Well, we received 562,907. 121,000 of that was for interest. So what's the remainder? It's reducing the lease receivable. So step 1, calculate your interest revenue. Step 2, you know how much your lease receivable comes down by. So 562,907 payment minus the 121,855, 441,052. So what the question here is, what amounts related to the lease would IC report on its balance sheet at December 31, 2018? Well, they're going to report a lease receivable on the balance sheet, and that's going to be equal to 2437 minus 093 minus the credit 441,052 or 1,996,041. That answers question 1. Question 2, what would be on the income statement? Well, we just have the interest revenue. Of 121,855. Now you might ask me, hey, these entries are different. This is the first cash payment, and here's the second cash payment. We didn't record any interest revenue on that first cash payment. Why? No time has passed. Interest is a function of the interest rate and the period of time. And so this happened as we signed the lease, there was a check cut, and we received that check, and there was no time passed, so there's no interest. So here, 0 interest. Here we pick up the 121,855. What would this look like from the lessee's viewpoint? We could just go do that really quickly. The lessee side, and again, the math doesn't change for the present value, because we're both, it's all the same payments, same interest rate, and everything else according to the problem. So we would, our first entry, June 30th, is we're going to have a right of use asset, and that's a debit, and we're going to credit lease payable. Now, as the lessee, they're the ones cutting the checks, right? They're the one using the equipment and cutting the checks. So they're going to, they're going to debit the lease payable. This is for that first payment, 562,907, and they're going to credit cash, right? What do they have on their books at this point in time? They have a right of use asset sitting there at 3 million, and they have a lease payable that equals 3 million minus this 562. So let's just put that down. We will need that. Lease payable balance equals 3 million minus 562,907 and equals 2,437,093. By the way, kind of lucky. I know that number off the top of my head almost, because it's the same number that the lessor had. So if you have an accounting problem, you got to do the lessor and the lessee. You've already done the math, whichever you do first. So it's easy to do the second one. Except don't forget, interest revenue for the lessor, interest expense for the lessee. So we go to 1231. And so the lessor is now going to have, they're going to, again, credit cash, and they're going to have interest expense. And they're going to debit that lease payable. They're going to reduce that balance. And what is the interest expense? It's that 5% times the outstanding balance, which is the same math that we did before. It's going to be 121,855, and we're going to credit cash 562,907. So the difference between these two is, it was the same as we just did, 441,052. That's 562,907 minus the interest expense equals this. Are we done? I hope you said no. This is what you'll forget on the exam. Easy to forget. We got to take care of the lessee. We got to take care of this right of use asset. We have to depreciate that. And so, again, we use it for 6 months. This is a 3-year lease. So we used, 1/6 of it, right? So there'd be 6-month period. So we take 3 million times 1/6 equals 500,000. So we're going to have amortization expense of 500,000, and we're going to reduce our right of use asset. So this is a different piece that's only on the lessor side. Now, what are they going to have? Let's just talk about their P&L expense. Let's do income statement first. They're going to have amortization expense, $500,000, and they're going to have interest expense of $121,855. So for expenses, they're going to have, $621,855. How about what's on the balance sheet? They're going to have a right of use asset. That's going to be 3 million minus the 500,000. And they're going to have a lease payable. That's the 2,437 minus the 562, or 1,996,041. There you go. Hey, that is lease accounting, my friends. Now, 15-5, I'm not going to work all this because guess what? It's exactly the same as 15-4, except for one thing. So all the math works exactly the same there. The issue is that the equipment only costs $2.5 million. So now what do we have? We have a finance lease with a selling profit. So, you know, we still record, Nothing changes for the lessee because they don't really care you got a profit or not. The lessor now has a profit. So we're going to still put that lease receivable on the books for $3 million. And, you know, this is a debit. We have to credit the equipment. That's got to come off the books. But it was a cost of $2.5 million. So guess what? They made a $500,000 profit there. So we don't want to just record gain because this is their business is selling this equipment. Unlike the last example, their business is probably all about interest. All they had was interest revenue. They bought it at $3 million. They lease it for a value of $3 million. They're in the game. They're a leasing company. They're in the game to get interest income. You may end up working for a company like that. Those are pretty cool companies. Here, this company is leasing just to help them sell stuff because they manufacture stuff. And so what we're going to do, we're going to credit revenues for what the value we received in that transaction, $3 million. And we're going to credit cost of goods sold for $2,500,000. So, you know, and I worked this over here earlier. So our income statement would look like this in 15-5. Revenues of $3 million minus $2.5 million of cost of goods sold, gross margin of $500,000, and then we would have interest revenue $121,855, $621,855. Lessee, nothing changes. So this is a finance lease with a selling profit. All right, we're moving along. $15.6. All right. Again, I'd ask you to, you know, pause the video right here. You'll be able to see the problem when you pause it and go work this one. And now you see how I've done it, and do it both from. This is for Manufactured Southern, who is the lessee. So I would just go do it from the lessee's point of view. All right, welcome back. Hopefully you took my advice and you're out there working that. You went out there and did the hard work on this one. This one is a lot of work, you know, because there's a lot going on here. So they leased electronic equipment from Edison Leasing. They purchased equipment. Edison purchased equipment for $112,080. What is the amount of expense that Manufactured Southern recorded in 2018? You know, so this is. There's 2 years of these. The lease term is 2 years with 8 quarterly payments. The quarterly payments are $15,000. The economic life of the asset is 2 years. The lease term is 2 years. So we know right off the bat, we are in finance lease territory. We're going to have interest expense and right of use asset and depreciation, amortization, all of that fun stuff. So let's get to work here. We need to find out what this lease is worth in present value terms. So the present value of annuity due, payment equals 15,000. N equals 8 quarterly payments, 2 times 4, 2 years times 4. And So I is going to equal the 8%, the implicit rate and the incremental borrowing rate the same, 8%, but divide by 4, 2%. All right, bring out the calculator. And this is at the beginning mode. If they don't tell you it's the beginning mode, assume that it is, but this one is. And I'm in the begin mode. Now check that on my calculator first thing. 15,000 payment in equal 8, interest equal 2, present value is 112,080. So I'm going to do my journal entries, for 1/1. Debit, right, abuse, asset. And credit, lease payable. And we've got a payment right off the bat. So we're going to debit lease payable for 15,000. And we're going to credit the credit cash. So we've already reduced that lease payable down. Okay. April 1. So we're gonna have to go. We have to do a whole year here. It's fun. And I'm going to keep over here. Maybe I'll keep down here a right of use, not right of use, lease payable balance. And I'm doing that because I'm going to need to know how to do the interest expense for each of these entries. So, 1/1/18, my balance was 112,000. Well, we'll just put that 112,080, and then 1/1/18 minus 15,000. My new balance was what, 97,080. And then I got my 4/1/18, my 7/1/18, and my 10/1/18, and my 1/1/19. Okay, there is a really good trick in this one if you try to work this. And I had teaching 1/31/20 class at night, and I had to try the students in there, and I made them work this while I waited for them. And I said, there's a curve here. And I had about 4 students who were accounting scholars at UNC. And I can't remember if they got it right or not, but they knew this is a tough curve, because it's just a little bit different. So I don't know if I would do it on the exam or not, but it would be kind of interesting. So, all right. So let's go do 4/1/18. So we got 1/1/18 done. We're going to credit cash again. I'm going to put that in 15,000. But this 15,000 is going to go to interest expense, and it's going to reduce the lease payable. Like an installment note, this 15,000 part's related to interest, and part is relating to reducing the principal, the lease payable. So what is interest expense? Again, it's 2% for every 3-month period. And we just went through 3 months. So 2% times the outstanding balance, 97,080. So I take 97,080. Nope, that's wrong. 97,080, 2%, 1942. So my interest expense is 1,942. cash paid for 15,000, the lease payable is going to come down by 15,000 minus 1942, 13,058. So minus 13,058. I'm keeping a running balance down here of my lease payable. So 97,080 minus 13,058 equals 84,022. I'm going to need that so I can do my next entry on interest expense. Next one, 7/1/18. Same entry all times. Entry debit interest expense, debit lease payable, credit cash, and I know that is 15,000. And so my beginning of the period at April 1, 84,022. That's my outstanding balance times the 2% interest rate. My interest expense is going to be 1,680. How much did my lease payable come down? Another way of asking that, how much of that 15,000 was not related to the interest? Because that part is reducing my principal, my lease payable. So 15,000, minus the interest expense is 13,320. This is a lot of work here. Minus 13,320. I had a credit, I debited that. So now my new balance, 84,022 minus 13,320 is 70. So this problem is requiring us almost to do an entire amortization table. Oh, that's crazy. 10/1/18. My next entry, I got to do it the whole year so I can come up with the answer. Debit lease payable. Credit cash. 15,000. My interest expense now is 2% by the new balance, 7702, 1414. So you can see my interest is going down, 1942, 1680, 1414, because my outstanding balance is going down because I'm paying part of it off. How much did I pay off this time? 15,000 payment minus the part that was related to interest, 13,586. Okay, now this is a very interesting one. This is where I talked about the curve. This is, if this was on an exam, it would be almost pure evil. We're trying to come up with the answer for 2018. The next payment is due on January 1, 19, not related to 18. So I got to take that off. This is a monster curve. It's crazy. 12/31/18, that payment has not been made. So we have not reduced that balance. Well, I didn't put this in, minus the 13,586 from October. Let me get my correct balance. 7702 minus the 13,586. 57,716. So in my T account, I'm sitting over there at 12/31 with 57,716 in my lease payable, right? Because I started with 112,080. I reduced it to 1305. I reduced it for that first payment, the second payment, the third payment, and this other payment in October. And I'm down to 57,716. When I'm closing the books 12/31/18, guess what? No payment's been made yet. That's the next day. And so I got to get this right. However, what do I have? Interest expense. I got to debit interest expense and credit interest payable. Because I got to get my income statement right, because that lease obligation 57,716 has been outstanding from October 1 to 12/31 for 3 months. So I got to take that times 2%, 57,716. 1154. No, 57,716. I might have an error here somewhere. 57. Oh, this is 116. 57,116. So 70,702 minus 13,586 minus 57,116, not 776. Take that times 2%, and you get 1,142, and you get an interest payable of 1,142. Wow, this is pretty crazy, isn't it? Right? So what is the amount of expense they recorded? It's 1142 plus this, plus this, plus this. So interest expense equals 1942 plus 1680 plus 1414 plus 1142. 1942 6178. Now, if you got this far, I'm sure, like, you're doing the exam, you've gone all this, man, you're tired, like, this is crazy. You just busted your butt. The exam is hard, all the multiple choice, and you're doing this problem, like a crazy problem like this. You think, whew, I'm done. I'm done. Thank God. What's the problem with that? You're not done. You're going to forget this entry. I guarantee you. What's the problem? What's left? That's not the only expense that we have as the lessor, the lessee, person using the equipment. Remember, we set up that right of use asset. We've got to amortize that asset. We've got to debit amortization expense and credit the right of use asset. Just, I promise you, you're going to forget this. So you can somehow, maybe when you get your first sheet of scratch paper for the exam, write this down, do something. So how much is that? We've used it for a full year, and it's a 2 years. We'll just use a straight line and take half of that, 56,040. So what was the expense for the year? 56,040. Amortization expense, and 6178 for interest expense. Wow, that was hard. I hope you got the right answer. If not, this would be one to go back and look at again, I think. If you can get this one right, at least you would have the lessee side down pat. And then again, please don't forget that amortization expense. Don't leave that right of use asset out there hanging. All right. Whew, this is hard work for me too. Last one. And thank God, we're not doing 5 years. This is a 5-year lease, but I think it's asking us only for the 2 entries. And I think that makes it, fair, kind of like how I would probably do on an exam. No commitments yet because I haven't made up the exam yet. So if you're watching this from my class, better be listening in class for what I say. So 15-11, let's go do the present value. And I assume this is annuity due. Let's see what it says. Yep, beginning of the year. And so the payments are 15,000. And the interest rate is going to be the same for the lessor and the lessee. We see that there. That's good. So we only have to do this calculation one. N equals 5 times 4, 20 quarterly payments. They help us out with that. And the interest is going to be 8% divided by 4, 2%. Let's go get the calculator out. Make sure I'm in the begin mode. I am. 15,000 payment. N equals 20. Present value 250, 177. After you guys see how easy this 12C is, you're going to want one of these. It's actually very popular because it cuts down the number of times you have to keep on something. You can move a lot faster. But if you get it, even adding 1 + 1 is a little harder than the regular calculator. You have to get used to it. I cannot use a regular calculator now. I can only use this one, but you might want to read how to operate it because you'll be confused. So let's do the lessee first. The lessee is ideal. And you want to make sure you have clear on that because maybe the multiple choice question will say, what was ideal's income expense for the year? And you're going to go, is that the lessor or the lessee? You have to come back to the problem, make sure you're clear on that. That's why I want to note that. So their first entry, 1/1/18. And fortunately here, they're only asking for the January 1 entry and the March 31st entry. So January 1 entry for the lessee is right of use asset. And credit lease payable. And beginning of the year, beginning of the period payment. So they're also going to cut a check and they're going to reduce that lease payable by the first payment. Lease payable and credit cash for 15,000. Next entry, 3/31/18. We know that entry is going to be debit interest expense because this is the lessee. And so we're going to make a payment and we're going to reduce the lease payable by part of that, like an installment note would, and we're going to credit cash. How much we credit cash for? 15,000 every single time. Interest expense is going to be 2% times the 250, 177 minus the 15,000, right? Because we've got to we take interest expense times the outstanding balance, and we credited that and then we debited. So it's really 235, 177. So 235, 177. 4,703. And so this remaining difference, that's how much the lease payable is going to come down. So 15,000. 10,297. Are we done? No, don't forget amortization, debit amortization expense. And credit right of use asset. Now, let's say straight line. So the straight line amortization, 250, 177. This is how many years? 5 years. So it'd be 50,000 per year. And this is only 3 months. So divide that by 4, 12,509. Don't forget that entry. It's an easy one. You know, a lot of times we get the complicated stuff right and we struggle with the easy one. So now let's go do the lessor accounting. We've already done the hard math. The lessor is called insight. So 1/1/18, they're going to set up a lease receivable for 250, 177. Now, we better go back and look at this because this is definitely a sales type lease, but is it with profit or no? And oh yes, the equipment has a cost of 200,000. I'm glad that we have this, and that this is the last problem. So we got to take the equipment off the books at 200,000. And therefore now we got to record revenues and cost of goods sold. We know cost of goods sold. And so revenues are the value that we received, which was in that lease, 250, 177. Again, only this entry changes in a sales lease with profit, only the first entry. This next entry, 3/31/18, is exactly the same as it would have been if we did not have a profit. And so we're going to receive cash. It's the opposite of it's the opposite of this one. Here's the lessee. They receive cash. They pay cash. We're receiving cash. And we're going to have interest revenue. And we're going to reduce the lease receivable. I'll do the math. Oh, I forgot one payment here. You know, let's go back to 1/1/18. I can't believe that. There was a payment. They received cash of 15,000, and they reduced the lease receivable. I almost forgot that first payment, first day of the lease. So again, now, you know, sorry about that. It's going to look a little confusing here. So my interest revenue is going to be the 2% here, 2% times the outstanding receivable. The receivable is 250, 177 minus 15,000, 235. So 235, 177. Of 4703. $10,297. Now I did the math, but I didn't really have to because it's the same math that was up here. Look how these entries, look at these two entries here. Interest expense 4703, lease payable 10,297, credit cash. Here we debit cash. We have exactly the same interest, except we're on the receiving side. So we have revenue and we reduce the lease receivable by 10,297. And that is 15,000 minus the interest revenue. So just like on the lessee side, when the lessor received the 15,000, part of it was for interest and the 4703, and the other part was to reduce the receivable balance. The principal comes down. So if you look at their books and the other set of books, the outstanding balance would be the same. So That's it for working problems. So I do really thank you for bearing with me with this. This is, I think I've done 3 chapters today, and I'm still going. I've still got energy here. I don't think I'm gonna do another chapter tonight, but again, I really appreciate your time. Thank you for bearing with me, and I wish you the best of luck on lease accounting.